Before we begin today, on behalf of the entire team, I would like to thank Cornell for extending the invitation for us to have the opportunity to compete today, as well as the judges for taking their time to take the time out of your busy days to provide us with your feedback.
We're still waiting for something.
Oh, okay.
Gotta thank him too.
Where's the time? Oh, right there.
Can we set the clock, please?
I'll take it. Sorry, I just noticed that going.
Okay, perfect. All right, you have 15 minutes.
All right, thank you.
Start.
LREI's investment in the Spanish market has been delayed due to the uncertain economic conditions that exist. As Spain rebounds from the worldwide recession, the opportunity for LREI to acquire a highly competitive and the largest unit in a highly competitive high street environment with low supply and high demand allows for the investment committee to show the opportunity to provide value and profits for its investors of its second fund. Influence Investments has analyzed the subject property, Mercado de Fuencarral, and is confident in our analysis to provide value-add opportunities for your investors. Joining me today on stage is a team that has worked diligently to analyze this property and decide on the best course of action available. We will begin today by providing an overview of the critical components of the deal profile before discussing the macro and local level conditions in the market, as well as the economics that exist for Spain's growing retail market. Rachel and I will then discuss a unique tenant strategy to provide profits for your investors, and our analysts will then discuss the financial considerations of the various scenarios and sensitivity and risk analysis associated with this deal. Madison, take it away.
Thanks, Alex. So the key players of this deal are Lampard Real Estate Investments, or LREI. The seller of this deal is Sol Inversiones, which we will be referring to as Sol for the remainder of this presentation. As a review, Mercado de Fuencarral is a 9-story mixed-use asset with 2,400 square meters of retail occupying the lower 3 floors, as highlighted here in green. We will be referring to Mercado de Fuencarral as MDF for the remainder of this presentation. The highest and best use for this asset is determined to be a single-tenant flagship store, which we have found is on trend in the market as of late. We are confident that Sol will go ahead and deliver the asset in white box condition in 2 weeks' time because of their strong motivations to sell, as well as MDF's low occupation rate of 60% and high tenancy turnover of 33%. While we did our base case analysis on the acquisition of the property in 2 weeks, we have also considered options if you do not get the asset within 2 weeks. When deciding on the going-in cap rate, we have taken into account every single scenario, and we have decided on a going-in cap rate of 6.8% with an optional hold period of 1 year. Our going-out cap rate is determined on cap rate volatility and market risks as well as other risks, which will be 5.6%. We will be delving deeper into this as the presentation goes on. Mercado de Fuencarral is located on Calle de Fuencarral, which is the yellow line running from north to south, which is a major shopping thoroughfare. The asset is marked by the red box in the northern part of the map. And the southern part is Gran Via, which is another major shopping thoroughfare that enjoys a footfall of 21,000 per day. It's important to consider the transportation locations nearby for a market that relies heavily on transportation. Notably, there are various metro stations nearby, including the southernmost one on Gran Via that's less than a 10 minutes walk away. This is important to consider because it brings value to both future tenants as well as future investors. I'll now hand it off to my colleague to discuss favorable market conditions for our recommendations.
Thank you, Madison. MDF represents a unique investment opportunity in Madrid because shoppers commonly spill over from the nearby Gran Via Precadillos area into the Fuencarral district. Please note that the rents shown in orange of the Fuencarral district are approximately 30% less than the Gran Via Precadillos district. This makes it an ideal area for retailers looking to break into the Madrid market. So far in 2015, market indicators have been overwhelmingly positive. A combination of favorable indicators in CPI, household consumption, as well as a drop in unemployment, shows us that the retail market will continue to gain strength in Spain. On January 1st of this year, the Urban Lease Act of 1965 was lifted in Spain, which eliminated rent controls on both the residential and commercial markets. This is important because tenants that currently pay rent-controlled rent grossly below the market will now have to renegotiate to market prices, and then it will also open the door for tenants who are looking to enter the market. Investment volume in Spain is on the rise in 2015, with a projected, and as you can see in the orange, we project that approximately 50% of investment volume in 2015 will come from outside foreign investors. Now I will pass it over to my colleague Alex to talk about leasing considerations.
Thank you, Connor. There are notable considerations to be given to each potential tenant in discussion. The first being Zara, a worldwide tenant, one of the largest retailers in the world with a prominent Spanish presence. They also have a concrete expansion plan, but unfortunately, the lease terms currently stipulated were not favorable, and it was difficult to justify a profit on this front. The next being Decathlon, an affordable athletic wear retailer that is both competitive and complementary to local retailers such as New Balance and Adidas. While they had favorable lease terms, this would be a new entrance for them into the market and difficult for us to establish for you to establish a brand equity when attempting to dispose of the asset. And finally, Topshop, a retailer that's looking to enter the market but has a notable international presence. There's also been notable investor interest expressed in past months upon the acquisition of this tenant in this retail space. We believe that this would lead to a possible easy disposition. However, the lacking corporate guarantee in the current lease terms provides difficulties when trying to dispose of the asset. Ultimately, we would like to recommend Topshop as the tenant for this location. However, this is contingent on the fact that your group is able to secure the corporate guarantee from them. In order to do this, we would like to recommend a 10% profit participation stipulation established in the lease terms. When LREI disposes of the asset, 10% of the profits from the sale will be forwarded to Topshop. This creates a mutual incentive for them to provide the corporate guarantee in order to secure the highest possible disposition price, since there's been generated attractiveness for this retail space. Given their power in negotiation as well as their opportunities in driving value to this asset, we believe that it's acceptable to offer a lower rent and an increased abatement in order for them to maintain their interest in this space. We're confident that you'd be able to achieve a 23.8% IRR with this metric, with this deal. In the event you're unable to secure the corporate guarantee, we recommend Decathlon as the alternative tenant. Although they are not currently established in the market, we believe that this allows for the confidence for you to increase rents as well as their term. It is important to note this higher IRR of 28.5% with this deal. However, the notoriety that's been associated with acquiring Topshop as a retail tenant could lead to a higher disposition price given our 1-year recommended hold period. I will now pass it off to Rachel for the final leasing strategy.
Thank you, Alex. So given all the tenants under consideration, we feel that Zara is not a viable tenant for this location. They do have leasing terms that are unfavorable, though in an attempt to renegotiate their terms, we were willing to increase the rent and increase their TIs. One reason that we feel that Zara is an unfavorable tenant is due to their large dominance of the Spanish and Madrid market. They do currently have a flagship location just north of Calle de Fuencarral, as well as a Zara home store in close proximity to MDF. As mentioned, we did try to negotiate their terms by increasing the rent and increasing their TIs. And by doing this, we've arrived at an IRR of 10.8%. See, this is far below the IRRs for Topshop and for Decathlon. So who shops at Fuencarral? Typically, they're those who are young. Typically, they're younger men and women between the ages of 15 and 30 years old. They seek trendy clothes within a price point that's relatively inexpensive. We like to categorize these shoppers as destination shoppers. Destination shoppers are those who come to our center to experience our destination. Secondly, we like to categorize these shoppers as destination shoppers because they spend a lot of time within the center. And what I mean by that is that they'll go and eat at the local cafe, then they'll go shopping, and then they'll go to a movie. All in all, they'll spend the entirety of their day at our shopping center, which is really why we believe Topshop would be such a great addition to this center. With the emergence of larger flagship retail centers like Zara, Lot of Color, Primark, H&M, as well as Adidas and Brandy Melville, we really do think that this would be a great tenant to put into the mix. While it would be competitive, it would also be complementary because these destination shoppers don't have significant brand loyalty to the brand, so they do like to go from store to store, and which is really why we feel Topshop would be the best alternative. Now I'm going to pass it on to Dustin to talk about financing.
Great. Thank you, Rachel. So when evaluating our debt financing options, we want to consider the loans through our hold period. And since we are recommending a one-year hold period, we believe that options A and B, or representing debt fund and a CMBS loan, are not viable due to the initial lockout period on each of them. So because of that, we ruled them out. Now, we did consider the positive benefits that debt has. However, we do believe that, since our optimal return is in year one, that we will not be able to execute this plan. This leaves us with the line of credit that your fund has access to, representing $100 million at a 2% cost of funds. Though this seems tempting as the cheapest form of debt, we advise against using it because of the recourse we believe that this line of credit carries recourse-bearing features, and you would not want to add additional risk to your fund. Thus, we recommend that you purchase this property using 100% equity. So you might be asking, how are we going to deploy this equity? So we are going to deploy this capital first by deploying the $15 million of additional capital that we require to purchase the property. Next, we will use $1.5 million that you will set aside in reserves in order to both improve the facade as well as commit to the tenant improvements in the lease terms. I will now pass it off to Oren to consider financial recommendations.
So now I'll be going over the financial recommendations. So as we heard earlier, there is a deal provided from a pension fund representing a 3.5% cap rate. We, on the other hand, went a conservative way, and we went with a disposition price of €32.4 million. This yields a 5.6 exit cap rate. We derived this exit cap rate by taking the approximate retail cap rate yield over a 10-year Spanish government bond. What's important to note about the pension fund deal is that this proves that there is market interest in a flagship Topshop on that street. Another thing is we believe that through our capital stacks and our tenant scenarios, that you were supposed to receive around a 22% rate. So as mentioned earlier, there's an IRR of 23.8 with a one-year disposition to an institutional investor. Next, I'll be talking about the sensitivity analysis. Something important to note about this is the abatements we offer to lure the tenant. This is important because our partition return is very key on the disposal price. From our market team, we learned that cap rates are trading between 3% and 7%. Because of this, we decided to sensitize cap rates and learned that a small change in cap rates drastically changes the IRR, and you can see the same in rent. Something to note is that we did sensitize other variables, but our main analysis comes from testing different scenarios as a whole. Lastly, in any real estate deal, there's many market risks. In this deal, we like to look at it and see that because of the market and the point of time in our tenant strategy, we believe that three big risks are being mitigated: demand, supply, and inflation. I'll now pass it on to Rachel to conclude the presentation.
Thank you. And in conclusion, post-economic indicators show strengthening in the market. We believe that this trend is going to continue in the future. Secondly, we would like to put Topshop into to fill the space of MDF. We understand that Topshop is a risky deal, but given our 10% participation, as well as our recapture clause, we feel that we've mitigated these risks accordingly. Lastly, we're choosing equity financing over debt financing because of the reduced volatility in returns. And now the main question that you're probably all asking yourselves is how much money are you going to make? With our one-year hold and our unique leasing and financing strategies, in our base case scenario, you will be making 10.7 million euro for your fund. I would now like to open the floor to any questions. Thank you.
Okay, so if we could backtrack a little bit, you did an analysis with Decathlon and Topshop. I very briefly looked like the IRR on Decathlon was higher than Topshop. Is that right?
Yeah.
That is
And
correct.
yet you picked Topshop without a guarantee, assuming you're going to get a guarantee.
So
Can you explain that?
yes, ma'am.
Oh, good.
So the stipulations of this is to understand that the drive in investor interest has been so expressed and buzzed about in the Spanish retail market that investors are interested in acquiring an asset that contains Topshop as a retailer. With that, in our market research, there was a pension fund, and as well in the past, for your group, there was a pension fund offer that expressed interest in acquiring the asset for 57 million euros months ago. To us, this expressed interest in the brand specifically, so that's kind of what helped drive this. While we didn't use the 57 million euros as a base case scenario, it was our most optimistic scenario. So that to us was telling that a higher disposition price could be achieved by acquiring Topshop as a retailer. And that's why we opted to Topshop as the main tenant for this location. Providing the participation incentivizes them to provide the corporate guarantee to remain attractive to investors similar to the one that contacted you regarding the pension fund purchase for 57 million euros.
To expand, if we don't get that guarantee, because that's incredibly important, we would go ahead and recommend that you go for a Decathlon.
Can you guys talk about this one-year hold, just the critical path? You're buying, you're signing a tenant, negotiating that, improving their space, get them in, open the store. I'm in month 19 now. So just talk about, is it appropriate as a fund manager to assume a one-year hold? And I'll give you a flash. Every deal looks amazing on a one-year hold, okay? There's very few that don't make the, sort of the numbers. So just talk about that.
Sure. So I'll shed some color on that. So the one-year hold was assuming that. So first, we're going to pursue Topshop because of the interest in the pension fund, and so we, through our analysis, are currently exiting at a 5.68% cap. We believe that this is within the market parameters of what we've observed, representing like approximately that 400 basis point spread between the 10-year rate. Essentially, how we think we're going to get there is because we're taking on the risk. In this case, we're putting 100% equity down, but even if you're putting a little bit of equity down, you still have the exposure to that, to everything going awry. Part of why, if you don't mind me asking, why are you? Sorry, let me just think about this real quick.
If you don't mind
me
adding.
Sure.
So if you look at your fund one, your maximum holds 4 years. So we do understand that you guys as a group like to act quick and swift. So we thought, when we looked at our analysis, the greatest IRR that we would receive in almost every one of our analysis and scenarios was in year one. And we believe that with offering all these exciting lease terms to the tenant, that they'd be crazy, not crazy, but it'd be hard for them not to accept such a great lease in this market, and this market's booming. So since we do that, we believe that it is plausible that we can get it we can get it done in the end of the first year. Note that our first year analysis doesn't start till December 1st because we gave ourselves a 4-month period to sign the tenant, to lease, to make the improvements, and then their lease starts. So if you take the 12 months plus the 4 months, you're around 16 months, right
How
around
long do
your.
you guys think it takes to build out a 25,000 square foot high design retail space in Spain?
We allotted 4 months.
Yes. We allotted for 4 months because the
Take
property.
you over.
What?
What's that?
I'm with you.
He's the developer. I just financed the developer.
So you're saying it should be higher? Okay.
Always takes longer to cross the
It'd
border.
probably take you 4 months just to sign the lease.
Yeah, especially because you're renegotiating the lease, and you're renegotiating in a way that most retail tenants are not prepared to analyze
And you're doing it in
or
different
respond
language.
to.
Okay.
So,
And
Yeah.
did you compare that 1 year unlevered to a 2-year levered?
Yes.
Yes, we
Yes.
And
Would
did.
you
Yeah,
guys-
if you would like to, yeah, if you would like to see that,
it's
absolutely.
really quick if it's easy.
Sure.
Are we doing? Would you like Topshop negotiated,
Yes.
Oren?
Yeah, so this is the levered scenario,
Yeah.
assuming the tenant.
So not shown is the IRR on Arm State, but if you look at a levered scenario versus an unlevered scenario, because you can't, of course, go out with debt in the first year, the unlevered scenario was higher in each one of our cases that we analyzed. So as you can see, you have the assumption tab right at the top right-hand corner. And when it goes through 1 through, this is 3 by the way, not 4. This goes 1 through 9 with different tenants in different situations. And in every scenario, it showed that it is better to go unlevered with the way we analyze the property.
Well, let me commend you on being creative on the lease negotiation. That was pretty cool.
yeah, that was
Yeah.
a good feature.
And I assume you didn't use any debt because you only had a 1-year hold.
Yes.
Exactly.
But how do you determine a cap rate based on the Spanish bond market? Cap rate should be determined based on what the market will pay for it.
Right. So what we got from the spread is that if an we looked at this and compared it to say a bond because real estate assets pay very similar to that of a bond.
They do?
Well, in the sense that it's cash flowing and it's yes that
Do you
it's.
think a better comp would have been what other retail spaces sold for? in the
Right.
market?
The retail space and as comparables, they were much smaller and very, very different, not as comparable as we'd hope.
So,
Yes.
So what we did assume was that you take the yield on the bond and look at the differences in cap rates and kind of apply that spread to the yields on the bond and looked at it in that light. And that's how we got 5.6.
And that's how the comps kind of became a difficult aspect of the analysis because when you review this the total square meters of the other retail spaces, this one is substantially larger than those other locations that have been compared in the past.
As well as the market volatility in Spain. It's continuing to be more favorable for investments. However, it's been changing a lot as of recent years because of the recession in 2014.
And on your scenarios where you had your cap rate scenarios and your rent scenarios, did you combine them? Because if you're getting stronger rents, your exit cap, one is going to be dependent on the other, right?
Right.
Yeah. Sorry.
That's okay. No, it's okay.
Okay, sorry to interrupt.
No, do it.
So we did, when I just talked about that assumption little marker, that changes different rents and cap rates all at the same time. So we did look at it in that light. In the sensitivity though, we did only change one variable to see how volatile that one variable would be without changing anything else.
Yeah, I guess I would add compliments on the creativity in the leasing and looking very carefully at the dynamics of the street, which you had a great map showing the other boxes on the street. I think you mentioned footfall, you mentioned rent control, those both showed pretty good thought about the micro. It strikes me that your risk-taking to go with Topshop and to go into a more complicated lease negotiation seems inconsistent with some very conservative assumptions that you used in the financial analysis, meaning your exit cap rate seemed to have been derived from a very conservative interpretation of the yields that would be required, and you didn't use leverage. So there was kind of In some cases, you were swinging for the fences. In other cases, it felt as if you were being too conservative.
And to mention something on that, of course, everyone likes an upside. So when coming to present you to show you, we didn't want to give you an expectation of 60, 70% IRR. We'd rather show you something that's on the lower side, because the upside is much greater, and most people aren't upset when they get more money.
Right. But on a whole dollar, on a whole euro basis, what you presented was a $20 million investment to make $10 million.
Right.
And a conservative analysis.
What's interesting to me is you sort of relied on the investor's interest to get interested in Top Shop, and you do that deal, and you sell it for 32, and you got a corporate guarantee. When they showed you, and who knows the substance behind it, 57.
Yeah, so.
In the real world, usually someone says 57. Even Donald Trump can negotiate him to like 50, okay?
So what that shows, that doesn't show, if you don't want, that doesn't show our negotiated with the pension fund. That shows a conservative aspect.
All I'm saying is, when you make decisions, there is a state of mind. You do collect data, you triangulate all this stuff, and then you do your models, and you throw your models away, and then you have to make a judgment, a gut feel. And in one part, you sort of relied on that recon to make a decision, at least pursue a tenant, recut the deal, and then that just gets thrown out, and you sell it for 32.
Absolutely.
It just is a little bit of a mismatch to me.
Absolutely.
Yeah.
Thank you.
And
Thank you.
Thank you so
Okay.
much.
Thank you, guys. Appreciate it.
Too political meeting?